Friends, welcome back. So this is going to be the last chapter of economics. So this is money and banking. Let's just do the MCQs first. The main function of money is medium of exchange. The bank which acts as the monetary authority of India is RBI. The bank which is a part of the money creating system of the economy are commercial banks. The rate at which the RBI lends money to commercial banks against securities is repo rate. The important tool by which RBI influences money supply is open market operations. Economic exchanges without the use of money, it is referred to as barter system. RBI is the only institution which can issue currency in India. Government of India issues coins to India. These are the matchups. SLR is statutory liquidity ratio. Circulation, Government of India. Money is the medium of exchange. M3 and M4 are broad money. Repurchase agreement is repo. So, what do you mean by barter system? It is a system where exchange takes place without the use of money. Give the meaning of money. It is a commonly accepted medium of exchange, and according to F.A. Walker, money is what money does. Time deposit. These are the deposits where money is deposited for a particular period of time, and it cannot be withdrawn before the stipulated time. What is fiat money? It is the money which does not have any intrinsic value. So intrinsic value is the value of metal or paper which is equal to the face value of the currency note. So what is high powered money? The notes and coins that are issued by the RBI and Government of India together is known as high powered money. CRR is cash reserve ratio. Bank rate is the rate of interest charged by RBI while giving loans to commercial banks. Next is the two markers. Any two functions of money, medium of exchange, measure of value. CRR and SLR. CRR, it is a certain percentage of bank deposits where commercial banks need to keep a certain amount of cash reserves with them. And SLR is statutory liquidity ratio where they are supposed to keep reserves with them in the form of liquid assets. State the credit control instruments of RBI. There are two, that's qualitative and quantitative. Quantitative techniques are the bank rate, open market operations, SLR and CRR. Qualitative techniques are the margin requirements, credit rationing, publicity, direct action, and issue of directives. Two motives of demand for money is the speculative and the transaction motive. How does bank rate influence money supply? So if the rate charged by the bank is less than the money supply, then the money supply will be more, and if bank rate is more, then the money supply is going to be less. So if you increase the bank rate, the loans taken by commercial banks, it becomes more expensive and reduces the reserves held by the commercial banks, and it decreases the money supply. So, why is RBI known as a lender of last resort? So, when commercial banks are finding it difficult or they are just going through the rough patch and they are unable to pay or lend loans to people, that's when they go and approach the RBI, and RBI provides loans to them, and that's how RBI acts as the lender of last resort. Next is the four markers. Money acts as a convenient unit of account. Explain this with an example. So the value of all goods and services are expressed in terms of money. So if we say that the value of pencil is rupees 10, so it means that we can buy a pencil with 10 units of money. So if the price of pencil is rupees 2 and that of a pen is 10, the relative price of a pen to a pencil is 10 divided by 2, that's 5 pencils. So a rupee is worth 1 by 2, that is 0.5 pencil, or 1 by 10, that is 0.1 pen. So if the prices of all commodities increase in terms of money, then there is an increase in the general price level, and the value of money in terms of any commodity decreases. So 1 unit of money can purchase, like in this sense that a unit of money can now purchase less of any commodity. So this is called deterioration in the purchasing power of money. Next are the functions of RBI. There are 6 functions. So there is PLC square BC. First is you need to tell something about RBI. You can just tell that it's the highest banking authority of India, established in 1945. Nationalized in 1949. The headquarters are in Mumbai, and the present governor is Shaktikanta Das. Next, the functions. Printing and issues of currency notes. RBI has the complete authority of printing and issuing currency notes. There are different denominations like rupees 10, 20, 50, 100, 200, 500 and 2000, and coins are issued by the government of India. Next is the lender of last resort. I just told it to you. RBI provides financial assistance to all commercial banks when they're going through their rough stage, and these commercial banks approach RBI for more money. So, controller of credit, the credit provided by all commercial banks is controlled by RBI. Implements both qualitative and quantitative techniques to control the credit generated by commercial banks. Next is controls money markets. RBI is the lender of the money market. The activities, the components, and all the functioning of money market, like commercial banks and financial institutions, all of this is controlled by RBI. Next is banker to the government. So on behalf of the government, RBI spends the money. It also collects money and also gives necessary suggestions with regards to financial matters. Next is common clearing house. It is called a common clearing house because it clears the mutual use of commercial banks through book adjustments. Next is the legal definitions of money. So the total stock of money in circulation among the public or people at a particular point of time is called money supply. So these are the legal definitions of money. M1 is equal to CU plus DD. CU is nothing but the currency notes, and DD is the net demand deposit of the public. M2 is equal to M1 plus M2 is equal to M1 plus savings deposit with post office savings bank. M3 is equal to M1 plus net time deposits of commercial banks. M4 is equal to M3 plus total deposits with post office savings organizations. So you need to remember that M1 and M2 are always narrow money, and M3 and M4 are broad money. You need to study the definitions as it is, because you cannot, deviate or change the definitions. So you make sure that you study the entire thing as it is. Next is the transaction motive and the speculative motive. So transaction motive, we all hold money for the day-to-day operations. Like usually people receive wages at the end of a day or a month or a week, so which is to be consumed till the next receipt. So thus people have the tendency to hold money in cash for various transaction purposes. It is represented as MDT is equal to K into T. T is the total value of transactions and K is nothing but a position fraction. Speculative motive is nothing but people use cash to invest in shares, debentures, golds, or properties, assets, or something like that. So the speculative demand for money, it refers to the money with the aim of earning capital gains and profits. So it is represented as MDS is equal to gamma max minus R divided by gamma minus R minimum. R is the market rate of interest, and R max and R minimum are the upper and lower limits. R decreases from max to the minimum, and the value of speculative demand for money increases from 0 to infinity, and this is known as liquidity trap. Okay, next is the 6 markers. We have 4 questions in this. So explain the functions of money. How does it overcome the shortcomings of barter system? So for any 6 marker or 4 marker, you need to always make sure that you have an introduction, the body, and the conclusion. So you need to always make sure that the examiner is able to differentiate between your body, between your conclusion and your introduction. So make sure that you write neatly, you make paragraphs, you make pointers and all of that, and you make sure that you have a neat handwriting, and then you draw lines after each answer, try to highlight your main points and stuff like that. So explain the functions of money. So first you write what is money. So it is a commonly accepted medium of exchange. It serves as a great instrument of commerce and industry by performing a number of functions. And then you make pointers, like there are 3 functions mainly. It's primary, secondary, and contingent functions. Primary functions, there's medium of exchange and measure of value. So medium of exchange is nothing but money is the commonly accepted medium of exchange. It facilitates the exchange of goods and services, and it has also solved the problems of barter system. Measure of value, money acts as a common measure of value. The value of all goods and services can be expressed in terms of money. This also solves the problem of lack of common measure of value. Next is the secondary function, store of value. Money can always be stored as it is not perishable. It can be stored for any number of days, and it has also solved the problem of carrying forward one's wealth under barter system. Standard of deferred payments. It can also be used for future payments. Deferred payments are nothing but the future payments or the contractual payments that you should do, like something like loans that you've taken for your house, for your car, or any assets that you own, or like you've taken various policies like life insurance or something like that. So those are like the contractual payments. Transfer of value. Money acts as a transfer of value from one person to person, from place to place, and money earned in different places can be brought or transferred anywhere in the world. Next is the contingent functions of money. Basis of credit. The modern credit system exists only because of the existence of money. Next is distribution of national income. It facilitates the distribution of national income among the factors of production in the form of rent, wages, interest, and profits. Provides liquidity and uniformity. Money gives liquidity to all forms of wealth, and it can be converted into any types of asset, and all assets can be converted into money. It also helps in consumers and producers equilibrium. Consumer attains equilibrium when the price of product is equal to its marginal utility, and producers reach equilibrium when they get maximum satisfaction. Next is just a story of a goldsmith named Lala on the process of deposit and loan creation by commercial banks. There was a goldsmith named Lala in a village. So in this village, they normally used gold and other precious metals to buy and exchange goods and services, and these metals were acting as money. So people in the village started keeping their gold with Lala to ensure safekeeping, and Lala also issued a paper receipt in exchange for their safekeeping. So slowly over time, the paper receipts issued by Lala began to circulate as money. So instead of giving gold for purchasing any goods or services for daily use, they started to give these paper receipts issued by Lala. And since everyone in the village accepted this as this common medium of exchange, these paper receipts started acting as money. So just imagine that Lala had 100 kgs of gold deposited by different people, and a guy named Ramu just comes to Lala and asks for a loan of 25 kgs. And Lala thought that all the people wouldn't come at the same time to withdraw their 100 kgs of gold. So he thought of giving the loan to Ramu, and he also thought that he could charge interest for it. So if Lala gives the loan of 25 kgs of gold, Ramu could also pay Mr. Ali with this 25 kgs, and Ali could get to keep these 25 kgs of gold with Lala in return for a paper receipt. So in effect, these paper receipts acting as money would have increased to like 125 kgs of gold. So this is how the modern banking system also works. Commercial banks mediate between individuals and firms with excess funds and lends to those who needs funds. So this is the basic story of Goldsmith Lala. Next is something about the open market operation. So this is one of the tools of RBI to control money supply. It is nothing but the buying and selling of bonds issued by the government in the open market. The purchase and sale is done by the government. It is entrusted to RBI on behalf of the government. So when RBI buys a government bond in the open market, it pays for it by giving a check. So this check increases the reserves, and it also increases the money supply. But when the selling of a bond by RBI to private individuals or institutions, this leads to a reduction in quantity of reserves, and it also reduces the money supply. So there are two types of open market operations. So that's outright and repo. So outright, they are always permanent in nature. So when RBI buys these securities, it is without any promise that they will to sell them later. And when RBI sells these securities, it is without any promise that they will buy them later. So the absorption or the injection of the money is always permanent in nature for the outright open market operations. Next is repo. So this is another type of operation in which RBI buys a security with an agreement to purchase it at a particular date at a price. So this is called repo, and the interest rate at which the money is lent is called the repo rate. So when RBI sells securities to an agreement which has a specified date and price, it is called reverse repo, and the rate at which the money is withdrawn is called the reverse repo rate. So the RBI conducts the repo rate and the reverse repo rate at certain maturities, like overnight, 7 days or 14 days. So these type of operations have become the main tools of the monetary policy of the RBI. So yeah, the last question, requirement of reserves acts as a limit to money creation. Explain. So the RBI has a certain percentage of deposits in which bank must keep as reserves. So this is done to ensure that no bank is overlending. It is a legal requirement and it is essential for all the banks, and this is called CRR. That is nothing but cash reserve ratio. So apart from the CRR, the banks are also required to keep some reserves in the form of liquid assets, and this is known as statutory liquidity ratio. So just assume that Canara Bank starts with a deposit of rupees 1000 made by some person, and the reserve ratio is 20%. So the Canara Bank has rupees 800 to lend, and the bank lends out 800 to Y, which is shown in the bank's deposit. In the next round, his liabilities making a total of rupees 1800 as deposits. So now Canara Bank from 1800, they must keep 20% as cash reserves, and the bank started with 1000 and it is required to keep only 360 as reserves, and it lends out 640. So the bank lends out 640 to Mr. Z, and this shows up in the bank as deposits. So this process keeps reserves keeps repeating till the required reserves becomes rupees 1000, and the required reserves will become 1000 only when the total deposits become 5000, because 20% of 5000 is 1000. So I'll show you a table to represent that. So this is the table. So these are the rounds: the deposits in bank, the required reserve, and the loan made by the banks. So in the above table, the first column shows the each round. Second column depicts the total deposits with the bank at the beginning of each round. 20% of these deposits needs to be deposited with the RBI as required reserves. The third and the fourth column indicates the loans made by the banks. So these are the 4 questions, and we are done with economics. So if you just study so much, I bet you that you get 100 on 100, provided you don't skip anything. I wish you all the best for all the exams ahead. If you have any doubts, please go down the comment box and I will make sure that I reply to all of them. And if you want the notes of any chapters, you can for sure comment it down and I will be able to send it to you people. So thank you.